By now you've already heard that the U.S. Federal Reserve increased interest rates, better said the Fed funds rate, yesterday, 75 basis points, or in layman's terms, 0.75%. And while the federal funds rate does not directly impact mortgage interest rates, it's still a matter of concern, and yet there's something else lurking in our future. Hello, this is Robert C. Baker. I'm a real estate agent located in the greater Chattanooga, Tennessee area, and I help folks buy, sell, and invest in residential real estate. And on this channel, I provide helpful information and tips on the national and local real estate markets. Even if you don't keep up with the news, you're painfully aware of rising prices. You see those prices every single time you go to the grocery store or the gas pump. And if you've been trying to buy a home recently, you've seen housing prices skyrocket. Inflation is touching everything in our daily lives. And after the U.S. Bureau of Labor Statistics released its May print showing that CPI, or the Consumer Price Index, had risen 8.6% over the past 12 months, it was a foregone conclusion that the Federal Reserve would raise interest rates. Now, yesterday's increase was the biggest rise in interest rates since 1994, and for those of us who've been around for a while, it kind of reminded us of Paul Volcker. The New York Times reported current Fed Chairman Powell saying that the Fed is not trying to induce a recession. The fact is, however, that with the Atlanta Fed now showing a zero GDP for the second quarter of 2022, we're already in a technical recession. In fact, I just did a video on that, and I would encourage you to watch it later. The Times also reported that the Fed's policy right now is setting a range between 1.5 to 1.75%. Numerous outlets are reporting that we can expect at least two other three-quarter jumps by the fall of 2022, and the Fed itself says that rates will be 3.4% by the end of the year. Now, the U.S. Federal Reserve does not set mortgage interest rates, but their policies, inflation, the economy, and so on, do impact mortgage interest rates. And as I shared in another video, rising mortgage interest rates are currently impacting the real estate market. How do rising mortgage interest rates impact the market? Well, first, they soften buyer demand. People are taking a harder look at how much it's actually going to cost them to pay for their mortgage every single month. Rising mortgage interest rates mean rising monthly payments. Now be sure to stick around because I'll share with you how a 1% increase in mortgage interest rates will impact your monthly budget. Second, rising mortgage interest rates also motivate sellers to begin reducing prices. While the Fed's rate hike is not going to affect your mortgage, it may impact some consumers. For example, home equity lines of credit and adjustable rate mortgages are directly influenced by the Fed's actions. Because of recent home price inflation, a lot of folks have begun using adjustable rate mortgages, or ARMs, to make their purchases, and their monthly payments will go up. Also, the Fed's actions yesterday mean that you're going to be paying more on your credit cards, car loans, and new student loans. Your credit card interest rate is going to go up every time the Fed raises its rates, so pay those balances off as soon as you can. When it comes to the economy, there are other areas of concern. For example, due to COVID, with all the federal stimulus and programs rolling out from Washington, a lot of folks began to save money and pay off credit cards and other forms of short-term debt. However, most of those programs are over, and the U.S. Fed notes a sharp decline in the U.S. savings rate while credit card usage is on the rise. But back to mortgage interest rates. NerdWallet reported that the average 30-year mortgage rate rose to 6.28% on Tuesday, which was the worst jump since 2013. Literally just 1 month ago, the Mortgage Bankers Association was predicting that a rate of 5% would close out the year, while in April, Freddie Mac predicted 4.6%. The Mortgage Bankers Association said 5%, while Lawrence Yun at the National Association of Realtors said that the rate may top out at 5.5%. And while yesterday's increase in the Fed funds rate is already baked into the 30-year mortgage interest rate, and while average rates rise and fall on a daily basis, it's hard for me to imagine that rates are going to fall anytime soon. Let me know in the comments section below what you think the 30-year rate is going to be by the end of this year. Now, the practical import of this, especially if you're planning to buy a home, is the following. If you're going to stick at the same price point or in the same price range as you were in January or even in March, your monthly payment is going to go up. So let's go to bankrate.com and use their mortgage calculator. Here I've already plugged in a home price of $400,000, a 20% down payment for a 30-year loan, and using NerdWallet's 5.872 as the interest rate. I've also plugged in some local data, a local zip code, for example, a credit score of 740, and as you can already see, that's giving us a monthly payment of $2,221. Now, because this is a conventional loan, there is no PMI, and let's assume there's no HOA fees. Of course, if they were, we'd have to plug those in as well. But let's go ahead and experiment, if you will, by reducing the interest rate by 1 percentage point, and you're going to see how that impacts your monthly payment. It actually reduces it by $200 a month. Let's go even further by reducing it 2 percentage points, and that's nearly $400 per month. So you can see how just a 1% change in the interest rate really affects your wallet every single month. Back to your budget. Because of rising interest rates, if you're planning to finance your purchase, you're going to have to take a hard look at how much you can afford each month and then adjust your expectations accordingly. And this may mean that you start looking at homes at a lower price point. But there's good news. As I mentioned previously, some home sellers have already begun to reduce their prices, and if we see a great increase in inventory, that means that prices could be reduced even further. If we have a ton of new inventory coming on the market for whatever reason, sellers will be forced to reduce their prices even further, and you may find yourself a bargain. Take a look at this chart from the St. Louis Fed. It shows that the 30-year mortgage interest rate on Friday, October 30th, 1981 was 18.44%. Now, do you think that folks were still buying houses with interest rates that high, or any other rate during the past 40 years? The answer is yes. People need a place to live, and so while a change in interest rate may either encourage or discourage some buyers, homes will continue to be bought and sold. As I mentioned at the beginning of this video, there is a really troubling aspect about all this, and it really isn't that the Fed funds rate went up or that mortgage rates are going up. Rather, the troubling aspect is the unsustainability of federal debt. Back in May, the Peterson Foundation came out with a report talking about inflation and the U.S. Federal Reserve's attempt to tamp it back down to 2%. Note what they say. As interest rates rise on U.S. Treasury securities, so too do all the federal government's borrowing costs. The U.S. was able to borrow cheaply to respond to the pandemic because interest rates were historically low. However, as the Fed increases the Fed funds rate, short-term rates on Treasury securities will rise as well, making some federal borrowing more expensive. Expectations about short-term rates and inflation have already pushed up longer-term rates as well. The growth of interest costs presents a significant challenge in the long term as well. According to the Congressional Budget Office's latest projections, interest payments would total around $60 trillion over the next 30 years and would take up nearly one-half of all federal revenues by 2050. Interest costs would also become the largest program over the next few decades, surpassing all discretionary spending in 2043, Medicare in 2043, and Social Security in 2045. Gene Dodaro, Comptroller General of the United States and head of the GAO, the Government Accounting Office, said, GAO's latest report of the nation's fiscal health paints a sobering picture. Without substantive changes to revenue and spending policy, the federal debt is poised to grow faster than the economy, a trend that's unsustainable. Want to know how recession might affect the real estate market? Watch this video next.